Welcome to the ULI Trends podcast series. I'm your host, Jeff Grasso. This podcast series is intended to be a lead-up of key topics and themes in our industry to ULI's annual Trends Conference, hosted on November 12th at the Hyatt Regency in downtown Salt Lake City. Today's episode will focus on the state of the Utah real estate capital markets with Michael King from Cushman, Wakefield, and Phil Brierley from CBRE. Welcome along, Michael and Phil.
Hello, Jeffrey.
You want to start off by please introducing yourself before we kick off?
Yeah, sure. So Michael King, I co-lead capital markets investment sales efforts for the state of Utah for Cushman and Wakefield. We cover all asset classes.
I'm Phil Brierley. I lead the capital markets team at CBRE, and I've been in Salt Lake City for 14 years, Chicago before that, and I'm from South Africa before that. As you're going to find out very soon.
We can tell by the accent.
Yeah.
We appreciate you being on today, guys. Before we get into our discussion, just want to serve up a few facts so our listeners can understand the importance and timeliness of this topic. Interest rates are materially elevated from historic norms over the past 15 years. Meanwhile, operating expenses and construction costs have escalated materially as well. We have elements of oversupply in the leasing markets across multiple asset classes. Investment sales volume across all asset classes have been severely subdued over the last 3 years, and developers are reluctant to start new projects. So with that warm and optimistic intro,
that's a good start.
Super optimistic tee up
let's
there.
dive into our conversation. So question for both of you. I'm noticing there's a dichotomy in development and acquisitions across both the industrial and residential markets. And what I mean by that is developers are reluctant to build and start a new project on spec, but yet investors are willing to acquire assets at very tight pricing, which is often neutral to negative leverage. What do you guys think is causing these fundamentals and why there's different behavior on opposite sides of the coin in our industry today?
Yeah, it's a great observation, and it's an interesting time in the market. I'll take it from the residential side, maybe just to kick us off.
Sure.
When you look at where all the uncertainty is concentrated, set aside supply for a second, because it's a lot of markets across the West, across the country are dealing with a glut of supply in residential, industrial. But I think when you look at the concentration of uncertainty, it's in all of those macro things that you just teed us up. It's interest rates, it's construction costs, it's tariffs, it's geopolitical, and it's outside of everybody's control, right? And I think it's really important to know that, Salt Lake City still has all the eyes on it. We still have that 10, 15, 20-year growth horizon. I think that's why Phil and I are both here and in this market, not being from Salt Lake originally. And I think that where you're seeing it really comes down to where's the risk tolerance. And I think it's not so much developers, but more about the equity, right? And the equity behind some of these developments. They would rather come in and get aggressive on existing assets that have a proven track record, a proven story, that are quality and a high barriers of entry and limited, transaction volume market like Salt Lake that has the fundamentals of 5, 7, 10, 15 years of growth potential.
So when folks are buying residential today at neutral to negative leverage, are they really just banking on rent growth?
They're banking on the performance in year 3, right? Not in the going in yield today. So yes, rent growth is part of it, but it's also everything that you hear about Utah, which is population growth, household formation still happening, the unaffordability on the for sale side, right? To buy a single family home here. And where are the asset classes where you see that longevity? And I think the argument and why we're all here is, residential and for rent housing has that long-term horizon, 10 plus years. Industrial, same deal. And I think that's where you're seeing groups get aggressive because they're looking at that 10-year horizon, not tomorrow.
So if folks are saying, okay, I'm looking at my return on cost in year 3, are they evaluating that supply pipeline and saying that largely abates 26 and the 27, at which point there won't be supply in the market and then they benefit?
Yeah, there's a lot of that, but I think to your point earlier, there hasn't been a lot of new construction starts, right? And that's where a lot of the uncertainty is. It's in the construction costs. How's the lease up going to go? How long is it going to take? Where historically, when we had limited supply, you could get through 200-300 unit lease up deal in less than 12 months. That's stomachable, right? And that was consistent. It's not that way anymore. So instead of getting aggressive on new development, they're getting aggressive on existing assets that have already proven that out.
Makes sense.
I think the The other part of that, especially on the industrial side, so we're an industry driven by debt and liquidity of debt and cost of debt, and options on where you can get that debt, right? And if we didn't understand that before 2020, we all are very aware of that now. I think what is interesting about what happened in the last 3 or 4 years is you had a ton of liquidity on the development side. Debt was obviously very, very cheap. Those banks now have a challenge with their existing portfolios where they didn't exit the market, but they substantially slowed down. Rates went up, but there was also just a challenge of getting to construction debt. If you look at what the construction lenders were out there, it was like Bank of OZK and a couple of other like local banks. And then you get right out of that into the debt fund world, which is higher octane and higher expense. So if your debt was 5.5 going in, your equity suddenly went from maybe where it was 5.5, now you're 7.25, 7. That's expensive. Your construction just got expensive. There's macroeconomic uncertainty. So just development, the whole package of it feels uncomfortable. Land prices haven't come down materially, and even if they did, it wouldn't probably make a huge difference. So the metrics on that are challenging. If you go to the other side of it, on the acquisition side, we've been talking about 3 years of perpetual inflationary environment. There's a ton of assets, especially on the industrial side, where your rents are here and the opportunity for the next tenant and the next ownership is going to be above that. So the mark-to-market story is aggressive. I think folks who are placing equity today looked at, do I do development where there's all of this headwind and these challenges? It's difficult. I need to be paid for that. Or do I go into acquisition where I think I can get mark-to-market opportunity and go and deploy into that space? I think the other piece of all of that was a lot of folks thought that there was going to be some level of distress in the market. If you go back a year, I think there was a much bigger dichotomy between the we don't develop anymore, we just buy acquisitions. 3 months ago, that started to shift. Like we're going to be doing 3 development deals at the moment, which is 3 more than we did 12 months ago. On the acquisition side, you've seen consistent cap rates that are super aggressive. Like the bidder pools for those are huge. And I think some of the folks are seeing the opportunity for the mark to market get squeezed out by very, very low cap rates. So that I think we're at a point where some of that's shifting around, and then the liquidity on the debt side is coming back into development a little bit because some of those banks have now figured out their books. So my take is we're probably going to see in the next 6 months a shift back into some development with certain assets, and maybe the bid depth on some of those acquisitions slows down a little bit.
So question back to both of you, both for industrial Phil and residential Michael. If that shift is starting to come and we've seen cap rates tighten up, what's that return on cost to get equity interested in a spec industrial project today? And I'm not talking about a bomber. I'm talking about a 200,000 square foot rear load, something mid-bay, shallow bay in that world that actually meets the demand in our market. What does a defensible return on cost have to be to raise capital?
6 months ago, they would tell you a 7, but it was 7.25 when you start to really look at it. Today, it's probably 6.5 to 6.75. And I can tell you real time that we're executing deals right there. So there's been a 100 basis point spread between where it was and where it is today.
And is that Northwest Quadrant focus? Is that Salt Lake County? Is it Wasatch Front? Like what locations does that equity want to go into today, perspective?
Equity wants to be in the best of the best. I mean, they want to be in Northwest Quadrant. Super land constrained, challenging to do. But if you can find a deal, that's where they want to be. I think if you go down to West Jordan or Davis County or Utah County, you're going to be 50, 75 basis points wide of that if you can find it. And I think on the equity side, there's very much a yes and no box. There's we'll do this deal or we won't do this deal, and it's probably not a spread you can give us to do the deal. Well, it probably is, probably 125 basis points. But It's tough to get people excited about doing equity deals outside of the best of the best of the best.
Michael, how would you answer that on the residential side?
Yeah, on the residential side, I like to say it only takes one, right? And what I mean by that is, you mentioned earlier, transaction volumes falling off a cliff. We've never had enough to sell in Salt Lake City, never. We've had all the eyes on us and never had enough to sell. And we went through a 40-month dry spell of core Class A multifamily trades. And so if you can't prove out where you can exit, you don't know what kind of spread, which means you don't know what kind of yield on cost you need. And so that's where we saw that widening out. We're finally seeing core trades in the market with Sugarmont at, a 4.65 cap, 440 a door in Sugar House. We're going to be bringing out, a big downtown project, here after Labor Day that's hopefully going to push push that up and cap rates down. And so there's now clarity and crystallization on where core multifamily is trading, which is helping get developers and equity comfortable with best of the best ground up development. Same as industrial. If you're not best of the best locations, there's almost no market for it. But if you have a core infill location, I think right now we're seeing deals get done 6.25.
And when folks are buying a 4.65 today, on the industrial side, it's a mark to market with a short wall. It's it's there to underwrite. On the multifamily side, are they buying the rate down through the GSEs? Is it just banking on outsized rent growth? Like, what gets them into that return on cost and out of negative initial leverage?
Yeah, a little bit of both of those, right? But I also think that what people are underestimating is I view your ability to underwrite concessions right now as an inherent value add, right? Because concessions aren't forever. When you look back historically, it was very typically 1 month free for deals that were in lease up, and once you stabilized, there were no concessions, right? And we will get back to that. Supply is falling off a cliff. It's going to normalize. And so your ability today to underwrite 6 to 8 weeks free, that's not going to stay forever. And when you run the math, your top line rent revenue actually can increase 15 to 25% depending on the levels of concessions. So that inherently is value add for new core deals.
Well, let's jump into some specific property types. Some of you have specialties in certain, and then my favorite one, you actually both do. We'll get to that one last. Phil, on the industrial market, vacancy has expanded, but it's been relatively tight. Having said that, demand has slowed down, and also the segment of demand is really pushed towards smaller users than larger users. But luckily, so is our supply pipeline has also been constrained as well. What's your view today on the industrial market, both as an investor and an asset manager? And where are the opportunities to place capital?
So this is probably going to be an unpopular statement. I think.
We like controversy.
Yeah, so it's controversial. Cole's going to kill me. I think it's the industrial market today is a less surefire thing than it was a year ago. There's some significant headwinds on the bigger box type of projects. If you look at what the hell is going to happen with tariffs, what's going to happen with onshoring, there's just a lot of unknowns on that space. You've already seen slowdown in the bigger bay industrial space. The small bay industrial space is still pretty liquid and still pretty active. I think we've seen a ton of capital moving into that space. It's tough in Salt Lake to get product in that area. But if you look at where there's softness, it's really in the 35, 50 to 75,000 square feet space. I think on our most recent count, there's like 48 spaces in that space within the Northwest Quadrant. And there've been about 10 to 15 leases signed a year in that space over the last couple of years. So we've got a couple of years worth of inventory to lease up. So where's the opportunity? I think there's opportunity in building small bay space. And there's some groups who are doing that now. I think there's opportunity in going to find underleased smaller base space, acquiring that, and then raising rents and pushing. And then, I think on the construction side, we just haven't seen a ton of construction. To your point, the construction pipeline's effectively gone away. There's 2.2 million square feet under construction. Of that, 1.1 is in one big asset. I think we're going to see construction coming back for those kinds of niche spaces. And then the whole other side of that, I think we're going to be looking at built-to-suits and manufacturing. Utah is very lucky that we've got a great manufacturing base. Manufacturing tenancy has been pretty active and has made up a bulk of what we've seen in terms of the larger space users. So I think if you can get to the built-to-suit manufacturing, be thoughtful about chasing down tenancy on the manufacturing side, I think there's opportunity there. I do think where it gets really challenging is the amount of capital chasing a limited amount of deals in Salt Lake City and the underwriting metrics that go into those things. I would tell you when the brokers are saying like, wow, that's a really aggressive price. That's a scary place to be in the middle of the industrial space.
So at what point on the acquisition side do you become a contrarian? Because the small bay mid-box product is trading at replacement cost, sometimes over replacement cost. Yields are thin. You have to believe in a lot of market momentum on rent growth continued. But on the opposite side, on the large bay space, you can buy at pretty wide yields. You can buy below replacement cost. When does that fundamental shift where large bay becomes cheap enough that people want that return profile?
I think it depends what your capital source is and who you are. And I think, so I think one of the questions you're probably going to ask us is like, if you had money, what would you do? I think the decision you're making as an individual or as a private capital guy or group is very different to the decision you're making as an institutional group. Right now, the institutional acquisitions people have a mandate, which is go buy a bunch of industrial, increase exposure. Core funds are trying to increase exposure to industrial. LPs are putting out money into industrial. That's going to continue. I don't think it stops. That world has changed. Whether those returns justify those acquisitions is tough to figure out, but the capital is there and needs to get deployed.
So it's kind of just like funds have capital, they need to put it to work, they need exposure to industrial, and they're looking for the best relative deals.
Yeah, and so I think Salt Lake is a relatively good return if you look at Salt Lake in terms of like, Salt Lake's like the Goldilocks zone in industrial comparative to the IE in Phoenix, right? So IE, you've got negative rent growth consistently. It's maybe a good buying opportunity if you're a private capital guy, but it's really hard to justify and get through IC how you're going to underwrite negative rent growth for the next couple of years. Phoenix, market's holding up pretty well. There's tenants in the market, but you've got supply pipeline that's effectively unending. Dallas is a little bit similar. Houston kind of similar. Salt Lake doesn't have a deep supply pipeline. We're pretty thin, but we haven't seen negative rent growth. If you're going to deploy capital in the West Coast, Salt Lake is probably the best industrial market in the West. And so we're going to continue to see that buoy acquisitions and probably buoy development. So if you're Jeff Grasso and you want to do a bunch of deals in Salt Lake, you should go partner with a big equity provider that needs to deploy.
Fair enough. Well, and to that point, bringing up the Inland Empire, that used to be the belle of the ball. Inland Empire was the greatest industrial market on the West Coast. Yeah. And typically when rents went down, demand went down in the Inland Empire, it affected all of the inland cities like a Phoenix, a Vegas, a Salt Lake, a Reno, whatever the case may be. We haven't seen that, right? And then the other fundamental is Inland Empire used to trade at the tightest cap rates, and markets like ours would trade 100 to 150 basis points over, and now there's parity. What do you think changed that perspective from institutional investors to embrace Salt Lake City over the Inland Empire in terms of pricing and rent growth underwriting?
I think the fundamentals in Salt Lake have been pretty steady Eddie for a long time. There's not a huge amount of delta between where we were 3 years ago and where we are now. Like, yeah, the things have changed, but they haven't changed at the same degree. Versus the IE during COVID just had these huge spikes. A lot of that was Chinese 3PLs and out-of-state 3PLs, and just there's an adjustment in the requirements that were being put into those port markets. Salt Lake hasn't had that, and so I think that we're in a period of time where Salt Lake is pricing maybe closer to parity, whereas the Inland Empire is pricing at a discount. There will probably be a time soon where that changes again. Sure. I think the liquidity premium as well in Salt Lake is real. It's hard to get product here. If product comes out in scale, like you saw with the two big portfolios that were sold, both the Link and the Starwood portfolio, people want to be here, and if you can get scale, you're going to pay for it.
Fair. That's a good point. Michael, let's switch over to the residential market. Everyone, we kind of hit upon this a little bit, but everyone talks about supply pipeline, elevated vacancy, expanding concessions. What's your general take on the market, and when do we get back to equilibrium based on what you're seeing on the demand and supply side?
Yeah. So just to throw out some statistics here, I like to bifurcate out vacancy and as overall, which in my definition, that's if you're delivered and you have units ready to lease, we're going to pull that in, right? So that's overall, that's our benchmark to check absorption, right? Then we have stabilized vacancy. And when you look at stabilized vacancy in the Salt Lake market, looking at downtown, Granary, Sugar House, more urban infill, because that's where 65% of the new construction is. When you bifurcate that out, stabilized being whether you hit 90% occupancy or you've been delivered for 18 months or longer, you get pulled into that calculation. We're at 6%. So once you get there, you stay stabilized, and demand has been extremely persistent. The suburban market's tighter because it's harder to develop. It's harder to find the land. Everybody wants surface parked, elevator serve on grade product, but finding 10, 20 acres along the Wasatch Front, similar to industrial, it's almost impossible, right? And so and then separate to that, you touched on construction costs, and it's construction costs are constant no matter where you're building. So if you're going to build podium, where can you get the yield? It's in downtown, in those urban areas where we're seeing, higher incomes and higher rents. And so when you focus on just downtown, right now we peaked first quarter where we had a ton of deliveries at right about 15% overall vacancy, right? That was a lot, and it's a scary number on the surface, but when you break it down, it makes it more or less scary, if you will. I think that the best of the best product are doing well. We're seeing true rent growth, base rent growth, in a lot of these Class A projects that we haven't seen before. We're just dealing with a lot of supply, and to quantify that, we've had 4 years of 2,000 units deliver in those urban areas consistently. So from 2020 to 2024, 2025, that is a lot of inventory relative to our existing inventory base, but we're making good swings at it. And I think come the end of 2027, we should be back at 7% vacancy or less. So we've got roughly another 18 months, I think, to get through this. But like I said, in the best of the best product, we're seeing underlying fundamentals, having really positive growth projections in rent and occupancy, but it's really isolated in those best of the best projects. Where I see distress potentially coming on the horizons in the 2010 to 2015 kind of commodity build, same big white box over and over and over again, that doesn't have any differentiation relative to the new product that's coming in from out-of-state developers in the multifamily market.
So speaking of new product, I mean, over the last 3 years, we've had 4 Type 1 towers deliver. I mean, the 4th is going to deliver here soon. We've had the Charles, we've had Worthington, we've had Astra, and now we'll have the Hines office to residential conversion. How are people responding to Type 1 product, given, increased construction costs, increased rents? We are somewhat of a budget conscious market. How are those products behaving today in terms of lease up and rent growth?
Yeah, I think lease up just due not so much by the product itself, just the sheer amount of competition in the market's been slower, but that's not isolated in the towers. That's market wide, right? I think the towers, you're building a tower here at elevated bases, right, that we haven't seen before, 600, 700, 800,000 per unit. You're doing that because you're planning to hold that for 10 plus years. That is a long-term horizon, and you want to deliver the best of the best quality, new to the market that it's never seen before. And the market is responding well to that. I think that, a lot of, and I think, a big part of that is we're seeing finally, high $3, $4 rents, right, that we've never seen before. And so we're getting the rents, we're being pioneering, the product's doing well. It's just going to take a little bit longer to absorb than we've been historically accustomed to, but that's also a product of deals are getting bigger, right? The average unit count in multifamily 5 years ago was sub 300. Now we're pushing and seeing 350. 377 unit deals like Astra, 425 unit deals like Camber. I mean, these are big deals, a lot of units to deliver in one project. Post District, 585, right? I think everybody delivering this product knows our lease up's going to be longer, but we want to deliver differentiated product that, and elevate the standard of rental living in Salt Lake, which they're doing, and they're seeing the results of that in elevated rents.
So kind of question on both. When's the next fill? When's the next time you're going to see a spec bomber put a shovel on the ground?
On industrial?
Yeah.
Oh, like tomorrow.
Okay.
I think that there will continue to be big spec industrial buildings happen. Because the fundamentals are perfectly aligned to set that in place. I think the uniqueness of Salt Lake is there are some large groups with large land holdings. They kind of have an opportunity to build when they want. Right now, no one is building that. So if it was my money and I had pretty low land bases and I could build it, I think it's a pretty good play.
Fair. Go
build a big spec bomber. I think the Ritchie Group recently announced some huge developments down in Utah County. Groups like that can do that. It's one of the things that makes Salt Lake a bit unique is that you've got almost like two economies. You've got the institutional real estate world, and you've got the private family office, kind of local family office real estate world, and they sometimes interact, but they often kind of move in two circles. Sure. So I think next time we'll see a big institutional bomber, I think it'll be a couple of years until we see that.
Fair enough. Michael, when's the next time you're going to see a Type 1 tower put a shovel on the ground in downtown Salt Lake?
That one's going to be a little bit longer. I think we got to test out the depths of the demand, right? We've got 4 pioneering projects all happening right now. I would say 36 months from now, you're going to start to hear of groups that have Type 1 sites, kind of the best core sites, start to plan and try to get out of the ground. But I think it's going to be about 3 years.
Fair enough. All right, well, let's transition about, I think our, and definitely my favorite asset class, because I like pain and punishment. It's called office. Can you both please walk us through the current status of the leasing market? When do you see vacancy tightening up? And what it will finally take for institutional buyers to come back to your bid sheets?
Those are very difficult questions.
Well, you're the experts.
Yeah.
So we're at the right people here to answer this.
I think that there's a bifurcation between those two things, right? Like the fundamentals in office are great. Right. Like, qualified really good post-COVID. I'll say that. If you look at
Is that an absolute statement or a relative
That's
statement?
a relative
It's
statement.
it's all
Let's
relative.
qualify this for the audience.
Relative, yeah.
If you look at the West Coast in general, right, and we track this, if you look at the West Coast, post-2020, most West Coast markets are sitting about like 65% of their leasing velocity, just on a gross level. Salt Lake is 130%, was 130% in 21, 22 was the same. The 4 best leasing years we've ever had was 21, 22, and 24. Like that's a wild thing to say. That doesn't mean we had a positive absorption. There was some shell game going on, and some of those tenants were moving around. We had some new deliveries, and so some of that absorption wasn't being taken into account. But there's leasing happening and there's velocity happening. When does vacancy start to come down? We've already seen 3 quarters of positive absorption. Vacancy is coming down. There's a bifurcation between good submarkets and functional submarkets and really non-functional submarkets that are going to change. I think like downtown feels great, Cottonwood feels great, some of the I-15 feels great. I think Silicon Slopes, there's some good pieces of it and there's some challenging pieces of it. That still has some time to work itself out. But like those are the 3 big submarkets. They all feel pretty good and they've all got better. On the capital side, there's still a ton of challenges around that. The challenges are getting substantially better than it was. If you look at, we were in the market with STCC, Southtown Corporate Center, last year around this time. It was May, June. And that was a much more challenging capital market than it is today. I think we went back to that process today. We'd see better depth of bid pool, and most importantly, we'd see much more liquidity on the debt side. And the debt liquidity has been the biggest issue. Is like pricing is a problem for sure, but just getting a lender is a problem. And that has changed as of probably January. We just started to see more folks coming back into that space.
What lenders are interested in office today?
CMBS, baby.
CMBS
Your
is
favorite 4-letter
great.
word. but honestly, it's pretty creative pricing. I mean, you've probably seen it, right? I mean,
if you're 400, 500 over, to your point about like where's the best opportunity, it's pretty hard to look at a 75, 85% leased Class A asset at 400 basis over the freaking treasuries and say, I don't want to do that deal. And we've even seen some equity funds say, oh, well, let's go become lenders because that's a much better spread that I can get anywhere else.
Mm-hmm. And a lot of those too, I think we've also seen, historic office operators now offering debt for quality office that they would want to own, right? And not saying that they're, sharp elbowed hoping that it fails, but they know they know what basis they want to be at. They know it's challenging to go in and acquire the best of the best. So let's provide debt for it. Feel really good about our basis. If it comes back to us, great. That would be wonderful. We know how to operate it. We'll take it back gladly. If not, well, we're getting our return, right? So it's a way to get into office with eliminating the risk a little bit, right? In my opinion, on the office market, I agree with everything that Phil just said. I think that those markets he mentioned, downtown, Cottonwood, for sure. Those are the best of the best right now. And I think where we're seeing a lot of the absorption is in the top 10% of the Class A space, right? So that's where I would be putting my money if I wanted to get into office, is go buy the top 5% of offices in any of the best submarkets in Salt Lake where you can quantify demand, because there's leasing and expansions happening where you can understand, like 95 State, the church is building downtown. They started at low 40s in COVID, and now they're pushing high $40, 47, 48 full service gross rents on the lower stack, right? And so there's demand for the best of the best office in Cottonwood, right? I think, you look at Heinz Cottonwood Corporate Center pulling Workday from downtown and landing that deal, and BMW and all of those, and then Cornerstone, right? Where all of these assets are pushing 90% plus occupancy, and you can quantify that demand. And I think that's where office is heading, is, really more like operating it like a nice hotel, providing a tenant experience. Where I question is the C office, the B minus, what happens to that? I think there will be a right sizing of office inventory. Maybe not, it's not your traditional absorption, but absorption in the sense of eliminating the obsolete, transitioning to industrial uses, transitioning to multifamily uses like Heinz's South Temple Tower project. That's going to eliminate some of the lower quality office out of the inventory, and that's going to leave better, more well-positioned, call it the next wave of office occupier type space for the market.
So my evaluation as a participant in the office market, you guys would call me with a deal and be like, hey, you can buy this deal at a 12 cap and it's got 5 years of lease term left. And I'm like, great. But my tenant might leave. Maybe there's some sublease space. Michael just hit on, I now need to amenitize my building. So likely my basis will materially accrete throughout my holds, and rents aren't going up, right? Mm-hmm. So I might buy that deal at a 12 cap, but on my underwriting, by the time I roll my rent roll and I do my amenities, I might stabilize to a 9 or a 10, so I have a dilutive yield throughout my holds. Mm-hmm. What's it gonna take for us to get back to a little more balance here, where you're buying a cap rate, you can add value, you can increase your yield, or you're just telling us that office is undervalued today, that's why it's trading at the 12 or the 14 cap. So that's the opportunity to get that cash flow in the near term to stabilize longer term at a tighter yield.
Yeah, I think so. Historical yields in this market pre-COVID was like 7.25 to 6.75. That was the magical number that happened for a bunch.
It's a lot of magic. We had a lot of magic in that world.
There was magic, yeah. When do we get back there? TBD. But right now
Do we ever get there? Where do we get to?
Oh man, that's a tough question. I think we get back there on certain product. I think that will come soon, like very soon, in the next 12 months. I think
we're seeing that in some markets around the country. Like in Dallas right now, the best stock is trading in the low 6s.
Yeah.
$700 a foot for some of the best stuff in Dallas. I think that we see sub 7 cap trades in this market on core product in the next 12 months. I think that the difference is that understanding what it needs to be and what it is has shifted a little bit. Some of the product we have in this market is under amenitized. It was pretty commodity built. Even though it's a 2015 build, it's still a commodity building. Mm-hmm. And the challenge is the tenants now have some options and can make those decisions. I think the big thing here is rent growth. We haven't seen rent growth in Salt Lake for lots of reasons, one of which is that we were able to deliver new assets pretty consistently over time at about the same rent as we've been able to do for a long period of time. That's changing. If you want to build a new asset today in the Silicon Slopes, it's probably $500 a foot. It's maybe 6 plus 6 downtown. There's a huge delta between what you need to get on that new build, call it $50 a foot, full service gross, and in the Silicon Slopes and where you are today, maybe mid 50s. And so that delta, as soon as you see the first new build, which will happen at some point, someone will be willing to pay that rent. You're going to see a huge gap between where we are today and where we are on that new build type of product. That gap is going to be bridged. And some of the tenants that need bigger block space today, anything that's 75,000 square feet or 125,000 square feet, really have not a lot of options. And so we've already seen rent growth. We've hit a high watermark in rent every single year since COVID. There hasn't in every single submarket except for where we're sitting right now in West Valley City. That's going to continue. And I think we're due for a hockey stick on rent growth. We just haven't seen it in a lot of years. And so it's hard to underwrite, but that's my takeaway.
I think we get back there. I think I might disagree with how quickly we get back there. And
I like Phil's opinion better then.
Yeah, no, you're not going to like me coming out of here as much. But I think it comes down to who has the capital and the appetite to buy office, and some of the best office at low to mid 6 caps or even a 7 cap. It's the big institutions, and what do they want to see in deals? They want longer term WALT and they want really strong credit, right? And quite frankly,
They don't
Utah
have a
just
lot of strong credit.
doesn't have it, right? And not only that, but set that aside for a second. I think it's more of a
And when we talk credit, it's investment grade credit.
It's investment,
Yeah.
not Utah credit. It's investment grade credit. And so a lot of those deals you look at that are getting those in some of those bigger markets, it's Google, right, is in there, and some of the just the biggest names. I think the bigger issue though becomes we are a low walt market, right? I mean, deals are done on a 5 year horizon. That means you got to put more capital in more frequently, and you don't have as much conviction in the cash flow long term, right? And I think where you're seeing some of those tighter cap rate trades are, if I were to guess, I don't know the specifics, but longer walt deals with credit where you have a ton of conviction in that cash flow and a lot of time for the debt and the capital markets to find itself, and a lot of time for that right sizing of maybe the lower stock of office inventory to get repositioned or taken out, right?
Makes sense. Well, move on here. I'd love an education, if we could.
Me too, Jeff.
As a
Me too.
buyer, publicly marketed processes have been very competitive and difficult to prevail on. Someone sitting across from me, I lost a public process in the last 12 months over $43,000. So it's very competitive. What do buyer underwriting assumptions have to look like today in your pro forma to be competitive across the asset classes we've chatted about in marketed opportunities? In terms of outsized rent growth, is it tighter cap rates? Is it a value add business plan because I have a vision that's different than someone else? Like, what are you seeing on your bid sheets and folks underwriting that help them prevail today?
Yeah, I'll take this one first. I mean, I don't know if there's one thing that you can point to. I wish there was, because it'd be easier to give you coaching and guidance here, right, and help you
Just
win.
pay more.
But
You just got to compress those exit caps, buddy.
you got to get more aggressive, buddy. That's
Get
it.
more aggressive.
No, but I think what we've talked about is, and this, because, and I will give you credit. I mean, nobody's been able to come into Salt Lake and get the amount of scale that you did in that amount of time, less than 12 months, right? It hasn't been replicated. It's really challenging to do. But the groups that get the most aggressive are the ones that are chasing scale. And the scarcity premium in Salt Lake City is real. And so when you wanted to get in here, how aggressive were you, right? You were very aggressive because you knew you had to be. And you had to be that aggressive to get the scale needed to make sense to enter our market. What you're now competing with, you're in the market. You've got your holdings. You're established. You're a household name in Salt Lake now. Everybody else that's the Jeff Grasso trying to break in here knows that in order to get the second, the third, the fourth, the fifth deal, they got to get the first deal. And that's all the buyers that we're seeing on a lot of this is they're stretching to get their first deal in Salt Lake because they have that long-term investment horizon here.
That's 100% true.
Phil, how do we win? What's your view?
Everything Michael said is correct. I think if you look at the last 3 big industrial trades, of those 4 big industrial trades, a lot of those groups stretched pretty aggressively to get the first deal. That was, we need to put a flag down. We need to be real. We need people to pick up the phone. And I mean, on the industrial side, how much of the market is marketed deals? It's not that much.
No, it's a lot of
right?
wealth
So how many of the deals you're looking at are marketed deals? You're too good for us now. You don't want to speak to me.
You're too good for me.
Because you're
too good at your job. That's what it is. You're too good at your job right now.
But the off-market deals are where there's opportunity, and the truth is that especially in the industrial space, there still is a fair amount of like horse trading happening. A lot of leasing brokers are selling industrial assets. They've got good relationships with those clients, and they end up just putting a deal together. And there's just a lot of that happens in Salt Lake, probably more so than other markets. Mm-hmm. And so the scarcity premium is get in and make a name. And post that, you could probably do 3 or 4 other deals, as you're well aware, that are more sweetheart deals. So on an aggregate, you're coming out just fine, but you got to pay for that first one. And the scarcity premium is very real. I think if you ask people what they think about Salt Lake, it's we want to be there, we just don't know how.
Mm-hmm.
Well, to that point, I mean, is the capital looking to partner with local folks? They're looking to buy direct? Are they partnering with folks from out of town who have some understanding of this market? Like, what does that intermediary look like between the capital and making the deal happen?
It's super interesting. I'll cover this. It's super interesting how it's changed over time. Like in the last 10 years that I've been here, it went from we're going to come in and we're going to like blow everyone out of the water. We're going to totally revolutionize things. I think what we see now, and this has happened to a couple of groups who came in as typical GPs, hired a person here and say, like, go find me some assets. They're not coming in as LPs or co-GPs. They're being much more reverential to people that are here. At the same time, many of the family offices or the smaller operators that have been here for a long time have realized they can, one, the check sizes have gotten massive. And so you're betting the farm every time you do a big deal. Maybe they don't feel great about that third generation or second generation to put $100 million out the door in one deal. So they want to spread that out. And two, they've come to realize that they can get cheaper capital from some of the LPs. And so that world is colliding. I think it's a good thing for the market. I think it makes it more liquid. We probably look more like Denver, hopefully not with the negative and all of the negative issues that they have. But I think in Denver, there's a ton of operators and a ton of LPs, and they work together. I think Salt Lake looks more like that in 5 years than it does now, and it already looks 100% more like that than it did 5 years ago. And almost, there's some bigger family offices that aren't going to do that, and they're going to continue on their path. But I think almost all of those, the local operators have come to the realization that there's opportunity out there by getting really good partners. And that I think is going to be a really big part of it, is like finding liquidity, finding equity, knowing how that world works. There's not that much of that in this market. So
well, Michael,
control
to
equity,
take you back off that though, and I'll go back to Phil as well. You're a local operator. You're now running into the space where the checks are getting large, or maybe you're a smaller operator and you want to grow into larger assets. What have you seen has been effective with local groups in terms of structure or pitching themselves, or how are they comporting themselves to be successful with institutional capital?
Yeah, and you're going to notice some themes here, right? And everything that Phil just said is spot on. And I think industrial's been more institutionalized than multifamily, right? Sure. I think the folks in that space are more willing to have the open arms and now say like, yeah, let's partner up. It's better for everybody. In multifamily, there's still this sentiment of, the outside capital is going to come in. They're going to take control. They're going to have sharp elbows. They're going to tell me what to do. And we don't want that, right? Our mindsets, our culture, our mentality are different. We're Utah. They're the big, grumpy New Yorker coming in and trying. Nothing's wrong with New York. I'm just saying there's definitely a sentiment there, right, of local Utah. And I think that we
could use Chicago as an example.
Chicago, sure. We'll say Chicago.
Okay,
but you're full blown Utah now. I can't offend you anymore. But I think that the best way to do it, we talk about scale, right? Everybody wants scale, and that's where you're going to get the best pricing and the best terms and the best partners, is if you can offer up that scale. And so there are so many local families here with so much scale and so much ability to say, hey, Mr. Institutional Partner, come in, let's recap our existing portfolio. That gives you immediate scale, right? That gives you yield day one. And now, hey, we've got these awesome development sites that, potentially might be a little tight on the yield to go off on a one-off basis, but looking more at it as a programmatic equity partner long-term than just raising for one-off deals. That's how you're going to attract the best partners and the best capital, and that's where you can go and find that go-forward growth equity.
I imagine there's some reluctance because the people who have the existing portfolios don't like the valuations today, so they don't want to take the discount on the existing portfolio to get the growth capital. Are you seeing that?
Yeah, and we're actually, we are going to be working on really the largest recap of existing multifamily in the market's history coming up here with a really quality local sponsor, a group that has that forward thought process that development's challenging. We want to go take advantage of some of the distress in the market, and we want to go and have an acquisition vertical, traditional developer, right? But we want to leverage our expertise to go buy existing assets below replacement costs. But we don't have that capital right now. But what we do have is an existing portfolio that someone can come in and get that immediate scale. I think that kind of mindset is the right mindset to have, because this capital is coming in regardless if they wanted to or not. It's better to be friends and partner up and let's go all make money together than it is to try to compete against some of the most well-capitalized groups in the country.
Phil, do you want to front run any of your deals since Michael's marketing on the podcast?
I'll be front running a couple here. Don't worry.
Okay. You can leave them in at any point as you'd like.
I'll put a little link at the bottom. Click on my OM. Something I will say that's going to be just a shameless plug is, so you asked the question of like, how do you access that capital? And I think one of the things that I'm grateful for that has changed a little bit in this market, I think the concept of real estate brokers as like completely fungible and just like, I'm going to hire this person, they're going to sell my building. And the concept of how that works, I think, has changed a little bit. And when you're talking about like LPs and GPs and putting equity together and doing debt, this is a much broader conversation than it is just like, hey, make me a generic offering memorandum and go and flog it and get it done. So I think that one of the things that is changing and will need to change more is how we as a community partner together with people that are doing that kind of stuff. And you should, if I was a operator, to your question, I would outsource that entire piece of it to somebody like a CBRE or Cushman or one of the bigger firms, because it's not like, for sure, Michael and I are sitting here locally, right? But we have access to people that talk to LPs on a consistent basis. They play golf with them. They're in their hockey, their kids go to school together. Like, that's the kind of relationship you need, and you can't find that in Salt Lake. You have to outsource it, and that's what we are going to need to think about, and that's the way we're going to need to frame the relationships going forward. Of like, you're going to hire us to sell your building, and to raise equity, and to do the debt, and all of those things. And it's a much bigger partner mentality than there is just like, hey, go flog this asset, and I'll call you when I need the next one.
Are you seeing that? I feel like we're seeing that mindset start to slowly shift, though, to more of that full advisory. As clients are reaching out to me, I'm sure you're seeing it now too. It's like, hey, getting us plugged in earlier. If you've got a deal multifamily that you want to sell in 6 to 9 months and you're in lease up right now, we're joining leasing calls, right? We're helping them position these assets to get the best possible number, to be the most attractive to the capital. I'm sure you're seeing that on the industrial side as well.
I mean, it's one of the reasons that our team went to CBRE, which was the partnership on the industrial leasing side and the office leasing side was so good there that if you don't have a whole team and you're not coming at this with a team mentality from a brokerage perspective, you're missing something. I think that the groups that are going to prosper from an operator perspective are going to be the groups that understand that world and say, like, all right, let's think about it long term. Let's think about a full business plan and a life cycle, start to end, and let's find the right partner for us, whether that's CB, Cushman, or somebody else. Let's find that right partner and let's just start from the beginning and go all the way through.
Makes sense.
Mm-hmm.
So this question, no Pollyanna answers. How is Utah viewed in today's market by institutional investors? And I ask this more from like a self-awareness standpoint. Like, are they saying to you, hey, I read an article in the New York Times 2 years ago that arsenic's going to blow out of the Great Salt Lake and decimate the Wasatch Front?
That was a dark time.
That article crushed us for 6 months.
Is it your housing inventory is not affordable anymore? Like, what are the knocks that you think we have to work on as local market participants that folks from the outside are acknowledging as some hindrance or high watermark to get into the market?
I have one that's not Pollyanna-ish, but it's also not that controversial, so I'll let you off.
But again, we like controversy.
I think the biggest challenge, not big challenge, one of the biggest challenges we have is a data challenge. I think as a market, we're renowned still to this day. We have pretty bad data. There's not a sense of like global sharing of information. Some of the brokerages share internally, but even within those brokerages and within certain groups, there's a sense like, if I keep this to myself, I can get outsized returns from my business, which is maybe true, but from a market perspective, I know a couple of years ago, we were sitting at a CCIM event, and we spoke to the head of Naveen, and the question was, if you had better data, would your cap rates go down? And she was like, yeah, absolutely. Like, I would get way more aggressive because I could look at the world and understand, and these folks are data driven and they're looking at 35 different markets. They need to be able to pick up my report, pick up Michael's report, and see the same things and be able to articulate to an investment committee how this is going to work. And if our data is choppy and difficult and doesn't really function well, we're just going to lose liquidity, and it's going to cost us and the investors in this market, it's going to cost them real money.
But given there's a scarcity premium of product, is that really an issue on the liquidity side? Because like I would say as a local operator, inefficiency is good. Right? Like,
sure.
If you know how to take advantage of it.
If everyone doesn't have the same information and you have boots on the ground, then you can get that information that can create value for you.
For sure. I think it's a very difficult thing to pass out. And in this particular instance, now you're a local Utahn now. Is that what we're saying?
Mm-hmm.
In this case,
I'm flying over Kansas or Colorado or something like that. So we're inching closer.
But I think there's a difference between, is it good for the people here? Yeah, maybe holding out your own data and some of that scarcity premium is good. If you want to think about how we're viewed I think we're viewed as a market where understanding what is happening is way more challenging. Maybe good for the market participants, but it's not great for us to be viewed as a wider market.
I think the scarcity premium comes from the long-term growth horizon of Salt Lake and not wanting to trade, right, as frequently as a Phoenix or some of these other markets, right? I want to take advantage of the 2034 Olympics and the pop that's going to come and all the growth that comes after that. I want to take advantage of, like for multifamily, affordability ratios at the true Class A product are in the low 20% right now. Look at the surrounding areas. It's 33-35%, right? That's runway and growth. It's going to take time to get there, but I think it stems more from you're in Utah. It was hard to get in here, so I'm not just going to go and sell a deal in 3 years or in 5 years. We have longer term holders here. I don't think the scarcity premium comes from inefficiencies in the market or the non-disclosure nature of the state or the lack of data for outsiders. I would be in full favor, and a lot of clients probably wouldn't like this, but full disclosure state to me makes more sense because, to Phil's point, I'm full agreement on this. The more data we have to get those groups that aren't here, the biggest institutions in the world are the most data-driven groups, and we always struggle to convince them of the returns, of the cap rates, of where things are trading because we don't have all of that data. Phil and I trade comps. Every deal we do, we tell each other, right? And I think that availability of data helps actually bring in outside investment in the market that's going to progress us into the next level.
Sure.
Jeff's furious. Don't tell him that stuff. He wants
It's okay.
He wants the special sauce, man.
No, when we sell, then we should sell for more money. That's what I'm hearing. If we have better data, okay, I can get my
Wait till you own
one
everything and then become a disclosure statement.
So, kind of piggybacking off this theme we're going on right now, with you guys' fingers on the pulse of, national capital markets.
Is that where our fingers are?
I mean, that's what you're telling me. You have all these relationships, your colleagues golf with the private equity guys, like you're having these intimate relationships with folks, right? And to your point, folks, local market participants aren't having these primary relationships. Maybe it's, secondhand or through a report or a Wall Street Journal article, whatever the case may be. What trends or advice do you have for local players as this institutional capital wave continues to evolve? How will that affect capital flows here, and how should people be thinking differently about this institutional liquidity?
Partner early and partner first, and help them come into the market. Don't push them out. Because if you do that, all you're doing is you're emboldening institutions that have a lot more experience, a lot more data, a lot more money to come in and do what they do. If you can say, let me help you get into Salt Lake, let's partner, you're going to need an expert boots on the ground operator because we do have a nuanced market. Our politics and everything here is different than a lot of other markets, right? It's nuanced. And you kind of had that shift in mindset and approach as you came into the market coming from New York. I mean, you can speak to that, I think, better than anybody, doing deals all over the world and then coming to Salt Lake. There's probably not another market that operates like Salt Lake does, right? And so instead of trying to compete and say, we're Utah, we know how to do it, I say open arms, partner, offer them the scale they can't get otherwise, because if you make those alliances now, over the next 10 years, over the next cycle, you're going to be better off for it, and you're going to make a lot more money.
Yeah, I think the runway in Utah continues to be, even though we've talked about some challenges and some tightness, the runway here still is very long term. I mean, I think Salt Lake is in innings number 2, and what we're going to see over the next 10 years is more of that shifting more from a kind of a local market to that institutional market. The more you can get ahead of that, get educated, think about that, partner with the right groups, whether those are market participants or folks out of the state even, I think there's a lot of runway to go, and we've got a ton of capital to be made.
Fair enough. I appreciate that. Well, question for both of you. If you both manage discretionary capital that was earmarked only for Utah, so open architecture, you could do core deals to opportunistic deals, how would you be investing it today, Phil?
Ooh, whose capital is it?
Yes.
Sovereign wealth fund from
The Saudis?
some country.
Was one of the Saudis investing.
What's the strategy you would advocate?
I think that if you're looking for outsized returns today, and for sure you got to be a stock picker, but there is office in Salt Lake, like if you would look at a place where the fundamentals and the capital markets are as far apart as humanly possible, I think office is an incredible investment. I mean, there are deals that are trading in Salt Lake that are best of the best. That for sure, there's challenges on the rent roll. There's issues around replacement costs. There's issues around TIs and putting new tenants in those spaces. But to look at where you can get really outsized returns, I think it's got to be office. And I think that those deals are pretty binary. I think there's a window of time where you can get them. I think that window is going to close pretty soon. So if you're paying 5% more for an office building than you probably feel like you want to, pay 5% more, pay 10% more. And at some point, you're going to continue to accrete office. You're going to build a portfolio at a basis that's 60% less than it was 5 years ago. Maybe the market doesn't get quite back to there. Who knows? I don't have a crystal ball, but it's got to be better than
It kind of has to, because new products can be $500
It's got to be better than today.
So you'd like to think over time, as new product comes on for $500 a foot, it's likely going to be somewhat similar to the stock we have today. That should draft up.
I think so. And if it's 2 years, 3 years from now, when those start to get built, I think you have a ton of runway between now and then. So I would take all that money and I would go buy the best office building that I could afford, and I would buy everything I could buy.
Fair.
I also sell office buildings, so
Just saying. You're not biased at all for earning any of your deals.
It is what it is.
What, do you have an office deal in the market right now?
We have a couple coming out.
Oh, okay. So stay
We have a couple
tuned.
coming out. Stay
Get his
tuned.
deals.
Put the link in bio.
Michael.
So do we, but that's
How are you investing your capital today if you manage discretionary pool of funds?
Yeah, I think that we see so many siloed funds coming into Salt Lake. I just do multifamily, I just do office, I just do industrial, right? Or whatever it may be. I think I would push for allocation across asset classes. And I think that is, every asset class has its day, right? And I think that can help stabilize across the board. From an office standpoint, I kind of talked about it. I would be getting pretty aggressive on the top 5 to 10% of office in the best submarkets, right? I think that there's long-term growth there. I think you're buying it at a basis. Like, I wouldn't be scared of 300, 350, maybe even 400 a foot for some of the best office right now, because, to build it is
That sounds like to me like a 222, a 111, a
222, 111.
Yeah.
Yeah, 100%. A Cornerstone, a Cottonwood Corporate Center, something like that, right? I mean, I would be getting aggressive and trying to pursue some of that, right? On the multifamily front, I would be going after the heaviest concession multifamily in the best locations, right? Because that ability to underwrite 8 weeks free, 10 weeks free, that's not forever. It's going to come up, and a lot of those deals are well below replacement costs, right? On the industrial front, I really like the shallow bay thesis. It's just trying to find those deals. It doesn't exist. You can't prove out the exit. Yeah. I wouldn't be scared of the exit right now, if I'm being honest. Having to exit, at 300, 350 a foot.
Selfish plug. We're bringing out. We'll be bringing out an asset just below $300 a foot in the industrial small bay space.
Yeah, and it wouldn't scare me.
Great cap rate. But it's going to be a good cap rate, and ultimately I think it trades around there. So
yeah, no, I really wouldn't be afraid of something like that, right? I mean, you look at what's been built, what's trying to get built. I mean, I think that product has a really long horizon. And then I also really like retail. I really like retail right now. When you look at the past 10 years, it's something like less than 1% of the existing inventory base of retail has been built, right? So no one's paying attention to it. And what's that?
Nothing trades.
Yeah, nothing trades, right? And so we had sub 6, really low 6 cap offers on really good neighborhood, unanchored, no national credit, no, and that stuff, it's interesting, right? Because those tenants, that's their livelihood, right? That's how I pay the bills. That's how I put food on the table. The national credit, you can just walk away, bankruptcy, it doesn't matter. I would go unanchored neighborhood strip in the best locations.
Makes sense. So last question to wrap up. Phil, what's your prediction for our market over the next 12 months?
To the moon. I think that the market, from a capital market perspective, I hope that the market gets progressively better. I think we're going to see interest rates come down a little bit. Maybe not as much as we'd like, but I think we do get some rate cuts this year, or if not this year, early next year. I think we see the best office trades go off. We see some terrible office trades go off. Terrible for the people who own the assets, not for for the market. I think we're going to see bifurcation of the best and the worst happen. I think the middle kind of sits around and waits. And I think that Salt Lake will continue to perform pretty well, steady Eddie, and rent growth in office will go up. I think rent growth in industrial will come back, and I think vacancy in industrial will shrink down, and development will come back pretty aggressively.
I look forward to that world a lot.
It's a pretty world we're painting here. Yeah.
Michael, what's the crystal ball for you?
Yeah, I'm not going to touch on interest rates because if we knew where they were going, we'd be on a yacht somewhere.
I've been wrong about interest rates
a million times, but I would say that I think we see record deal volume relative to the past probably 3 years. I think we're going to see a ton of deals start to come to market in trade, specifically in multifamily and office. I think we even see some bigger trades in industrial as well, and certainly in retail. And I think that, everything that Phil and I'm sure are working on is advisory, to kind of prepare these deals for, Q4, Q1, Q2 next year disposition. So I think we're going to see a ton of deal flow. I agree on rent growth in the best of the best office in those submarkets. I think we're going to see concessions start to really fall off a cliff in multifamily, and that's going to start to get some of the bigger developers back in the game and interested. I think we see a number of called mid-rise wrap podium deals in downtown get out of the ground in multifamily, but not even remotely close to the amount of supply that we saw over the past 4 years. Really maybe 1 to 2 deals a year, but they're going to be some of the best locations.
That makes sense. I mean, I hope your predictions come true. I would be a big fan of that, and we'd have a little more fun in the real estate market.
I'm looking forward to having some more fun. It's been a tough couple of years. I'm ready to have some fun. Let's go to get a yacht, man.
Yeah, let's go do it.
On the Great Salt Lake where the Arctic
Yes, it'll be like a small fishing boat.
Well, Phil and Michael, thank you so much for your time today. I think it was a great conversation. I know our audience will appreciate it. And to our audience, thank you for tuning in. Look forward to seeing everyone November 12th at the Hyatt Regency in downtown Salt Lake for our annual ULI Trends event. Appreciate your time, guys.
Thanks, Jeff.
Thanks, Jeff.